4 lessons I'm going to teach you today. First, I'm going to introduce you to one of the least talked about harmonic patterns in trading. Then I'm going to show you how to identify both valid and invalid trends using some simple price action principles. After that, we're going to dive into Elliott Wave Theory, and don't worry, I promise I'll keep it simple, but I will share with you some hidden insights that most traders don't talk about. And finally, we'll explore Dow Theory, which is the foundation of modern technical analysis and pretty much the basis of how markets move. Now, on the surface, these may seem like 4 completely different principles, but by the end of this video, you're going to see how they're actually all connected and how if you use them together, you'll be able to see a much clearer story of what the market is trying to tell you. And trust me, once you see these connections, you'll never look at technical analysis the same. So no fluff, no gimmicks, just quality education. Let's hop in. So I want to start off by quickly teaching you the 5-0 pattern, and full disclosure, this isn't a pattern that I personally trade, and therefore I don't have my own little personal touch on it. For example, when it comes to advanced pattern formations like the bat or the Gartley or the cipher, I have very specific rules for each leg requirement, and if those aren't hit, it isn't a valid pattern. What I'm going to teach you here from the 5-0 is what I personally remember when I learned about it, and give you some hints on where you may want to plug in your kind of personal touch. So, like most patterns, we start off with an impulsive move. This is going to be our swing high to swing low, clear directional move. Unlike the other harmonic patterns, instead of starting with an X leg, this is actually going to start with what's called a 0 leg. So our 0 leg is going to be the high, and then our low is going to be the X leg. Our first retracement after this low, this is going to be our A leg, and this is where, if you decide to trade this pattern, I would definitely encourage putting in a very specific rule. And I say that because there's no real requirement for where this A leg has to come to. There's not a minimum, there's not a maximum. It just has to exist. And well, that's just a wide range for traders to deal with. And hey, maybe you don't put in something, but I would definitely investigate that if you want to trade this pattern. Now, after this A leg, just like the cipher pattern, we're going to get an extension to the downside, but it's going to be a shortish extension. So it's not going to be as far as an AB equals CD. It's going to be somewhere in this range. And this actually does have a very specific Fibonacci range that we must hit. If I take my Fibonacci extension tool and I invert it from the A back to the X and back up, what I'm going to look for is a minimum requirement of price coming to our 113, which is going to be right here, and a maximum requirement of price coming to our 1618. So the exact zone that you see I have drawn in with my Fibonacci tool, this is the area in which this B leg must come to. Now, Tier 1 members, I know what a lot of you guys are saying because we have this rule for the cipher. Does it matter if it just touches? Does it have to touch? Can it close? Can it not close? Once again, I have no idea because I don't personally trade this pattern, but that is certainly something you'd want to investigate and certainly something that you'd want to have a rule for. So next up is going to be our C leg, and this is going to be our longest leg as we're going to travel all the way up past our A, past our 0 leg, and beyond in order to get our C leg all the way here at the top. And to measure our C leg, we're once again going to take our Fibonacci extension tool, this time inverting it from the low of our B to the high of our A and back down. And we're going to look for a range of completion between our 1618, which is a little bit low in this case, and our 224. So let me just kind of get that on here. I should have it somewhere saved on my Fibonacci. Bang, 224. Oh, look at that, almost to the exact spot. 224 right here. And again, we want that C leg to occur or complete above the 0 leg. Now, after that C leg completes, we have one more retracement that we're looking for, a move back down, which is going to be our decompletion. And we're going to have a nice little zone for this decompletion. Let me erase some of these fibs to make life a little bit easier for you. But we're going to look at one of 3 things. One is going to be a reciprocal AB equals CD, right? So the traditional AB equals CD looks like this: an extension, a retracement, and then an equal measured extension with the BC being equal to the AB. A reciprocal AB equals CD is the opposite, where instead of looking for an extension as being our starting point, it's going to be this smaller move right here. And then I'm going to copy and paste the length of that drag it up here, and boom, that's going to give me the first zone of my decompletion. So reciprocal AB equals CD is 1. 2 is going to be a Fibonacci retracement from our B leg to our C leg, and 2 is going to be our 50% retracement right here, and 3 is going to be our 618 retracement right here. So the zone between our reciprocal AB equals CD, our 50%, and our 618, that is the zone that we're looking for completion when it comes to our 5-0 pattern. So again, this should give you a basic idea of how the pattern operates. If you are going to trade this, my advice, and this is just my teaching philosophy, you want to have clear and concise rules of what needs to be hit, where it needs to be hit at, especially when it comes to that decompletion. But for purposes of this video, so that you understand what's to come next, here is your bullish 5-0 pattern. Boing! If we read the story of the market with the 5-0, I want you to follow me along this journey, right? So now I'm not going to draw these ratios out to the right levels, but price action comes down, right? Then we get a retracement. Then we get a move like this. So what does this tell you right here? What story does this tell you? A few things, right? One, yep, we get a break and close below the low, which puts us in a bearish trend. But also, what do you notice about the extension? What's our rules on measuring trend strength? If extensions are getting shorter, is that a sign of a slowing trend or a trend that's picking up steam? That's a sign of a slowing trend, right? So it's still a trend, but like in our head, our spidey senses are starting to tingle, right? Now, it doesn't do anything for us yet, but then we get a couple moves here. We get this move right here, which does what? Just the basics of reading a trend, right? So bearish trend, this time movement from top left to bottom right is the simplified bearish trend. Bearish trend on a chart, simple. Top left, going down to bottom right. How to read a bearish trend? The exact opposite of the bullish trend. So in the bullish trend, we're looking for consistency in higher highs and higher lows. This time we're looking for consistency in lower highs, right? So the highs are getting lower, and lower lows. The lows are getting lower. Bearish, same thing, but opposite, flipped, right? Our series of lower highs and lower lows tell us we're in a bearish trend. Once price violates that previous high, so right here we have the what? We have the violation of our previous outside return, which puts us in a what? A rotation, right? And a bullish rotation. Doesn't mean a bullish trend, but we're in a bullish rotation, meaning that the bearish trend has been violated, and now we're scratching our head like, yeah, we can be in the very beginning stages of a bullish move. So not only do we do this, but in the 5-0 pattern, we not only violate that level, but we violate the starting point of that trend as well. We take out 2 levels of structure. Pew, pew, right? And obviously we have a big extension up. Well, not technically an extension, but a big move up. So we would all agree that this is a very bullish sign, right? Would you guys agree? A very bullish sign here. We take out 2 levels of structure in a single swing. And now, after such a big, powerful move that takes up all of our energy, what would you expect to happen next? Markets don't go up forever. They give a little bit of a breather, right? So they have this relief, right? And this is the same thing we look for in the butterfly pattern. Remember, in the butterfly pattern, we look for the extension. In the butterfly pattern, you look to take advantage of trading the relief, right? More like a counter trend trader. In the 5-0, right, you're waiting for that relief to happen. That relief comes down, right, back into this level, right? I believe it's the 50% from, again, I don't trade this if I remember correctly. It's the 50% level of this. There we go. So back into this level, and then you're looking to take this move. So what type of trader is this? You have rotation, you have initial structure high. This is your first pullback or outside return. and you're looking to take advantage of a newly formed trend. So this goes, it's awesome because Devin actually just wrote about Elliott Waves, I believe, right? Have you ever thought about combining Elliott Waves with advanced patterns? I have not. No, I am not I am very familiar with Elliott Waves. I took an Elliott Wave course, which was a really great, it was a bad course, but a great teacher. If that made sense. It was a really good teacher. That the course was really dry and boring. So I understand Elliott Waves and the way that they move into market. I do not take them into account with advanced patterns. Not saying that they don't play a role, and I'll show you kind of an example of an Elliott Wave right now. And I can show you another example of Elliott Wave. I'll give you two examples. I don't see them as benefiting how I trade at all. So they're cool to know. I like to understand it. It was a cool continued education session for me. They just don't bring anything of relevance to my trading. But here's a cool example, right? So if the Elliott Waves work in waves of 5, right? So before moving on, I want to take a quick second to teach you a little bit about the basics of Elliott Waves and Elliott Wave principles. That way the next section of this video makes sense. In general, Elliott Waves are no different than the normal ebbs and flows of price action. It's reading the market during its extensions and reading the market during its pullbacks. Now, the difference with Elliott Waves is that there's going to be a very specific amount of extensions and pullbacks that you're looking for. And I guess you could say a very specific pattern that we're looking for. So Elliott Waves are measured in waves of 5, followed by an AB equals CD, or maybe just an ABC, depending on how you like to measure it. The first move is going to be our extension right here. The second wave is going to be our pullback right there. The third wave is going to be our extension right there. The fourth wave is going to be another pullback down here. The fifth wave is going to be our final extension up here. And then here goes our AB equals CD pattern. Some people just like labeling the A here to B there to C there. I like labeling it the AB equals CD pattern just because I'm used to AB equals CD. But it doesn't really matter how you want to draw it. And pretty much this is, if we go back to the Dow Theory and the Wyckoff cycles and whatnot, this is your first extension, your first pullback, your bigger markup, another pullback, and then one more kind of shallow extension, followed by a multi-leg pullback, or as we like to call it, a complex pullback. Now, not to get into too many details about it, but there are some specific rules that you want to look for when trading Elliott Waves. The main one, if you had to choose one, is that the third leg needs to be the biggest leg. So this needs to be the strongest extension, the furthest, the largest, however you want to word it, extension in the series. But there are a few other rules that you may want to look for as well. And again, I'll go over this briefly because I don't want this to turn into an Elliott Wave lesson. But one, wave 2, so this first retracement, this usually comes anywhere between 50% and 618 of wave 1. So if you take out your Fibonacci tool and drag it from the swing low to the swing high of wave 1, it should come anywhere between the 50% and the 618 level. Wave 3, so the end of this extension right here, should be anywhere between the 1618 and the 2618 Fibonacci extension level of that wave 1. So if we take a Fibonacci retracement, or excuse me, extension from our swing low to swing high like that, we should be looking for a 1618 somewhere to a 2618, which is not on my chart, but imagine it's up here somewhere, length of extension there. This second pullback, leg number 4, wave number 4, excuse me, this should retrace anywhere between the 23.6 and the 50% of leg 3. So once again, Fibonacci retracement from our swing low to our swing high. I don't have a 23 up here, but you can imagine it's somewhere up here. So that would be the 23.6, and then should be before that 50%. That's the area of retracement that we're looking for in that. And then finally, the end of our fifth wave up here, that should end at a 1618 Fibonacci extension of wave 4. So inverting our Fibonacci from swing low to swing high backwards right here and looking for that 1618. So just a reminder, I'm not an Elliott Wave specialist. I did study Elliott Waves. I don't really use them in my trading, but I do understand the theory. Therefore, I do feel qualified to talk about them to you. But from what I've heard from most traders that I used to meet with that traded Elliott Waves, you don't really trade them on their own, meaning you're not just an Elliott Wave trader that looks for Elliott Waves and trades them because they're Elliott Waves. You use them with other aspects of your analysis. So you do other maybe price action analysis, and if it lines up with a certain principle of your Elliott Wave theory, well, that's just more confluence for that trading idea. So hope this gives you enough just to kind of give you a general overview. Now let's hop back into the lesson. If we're taking this 5-0 pattern right here, and we're coming and we're doing this, right? We have this rotation. When we're in rotation, should be a little bit shorter, sorry. Like that. When we're in this rotation, right? We don't have a trend. When we don't have a trend, we're in a period of what? Consolidation. Would you guys agree? Yep, period of consolidation, right? So we come out of this period of consolidation. This is pretty much a breakout. So this is going to be wave 1, right? We have our pullback. Sorry, we have our pullback right here, right? That's going to be wave 2. This pullback is the entry reason for our 5-0 pattern, where we expect a move up. Now, who remembers what wave is the longest wave in a Elliott Wave series? I don't even know if you guys know about Elliott Wave, so that's probably a bad question. In Elliott Waves, the 3rd wave is the longest wave. This is the sweet spot, right? You see what I'm getting at now? So off of that 5-0, you've involved yourself in the 3rd wave. Then we have our 4th wave, then we have our 5th wave, like that, where the trend starts to kind of slow down a little bit. And then, Devin, if we want to take into account, right? You get your AB equal, your quote unquote AB equal CD pattern that looks something like that. You guys see it yet? You guys see it? You guys see it? You guys see it? You guys see it? Yeah, right? Often an advanced pattern formation before the market either goes back into consolidation, right? Or continues up. Really cool stuff, right? Really cool stuff. And just to continue our label, this is, sorry, 4, this is 5, and that's your AB equals CD, right? So you can see how Elliott Waves in general, right? In general price movement, not even this, but the whole just like Dow Theory or Wyckoff cycle of kind of consolidation, markup, distribution, markdown, right? It's all, this is all that movement, right? This is, I get nerdy over this stuff. This is all of that movement. The market starts off in a phase of accumulation. This is like when the buying starts to happen. In real life, this is like a lot of the smart money institutional traders. They start their buying habits. They're very sneaky with how they do it. You don't necessarily see the market explode too much. It's kind of like, you know, probe. Like imagine a volcano before it erupts. Everything's happening below the surface, which is making the lava increase, but it hasn't yet erupted. Your second phase per Dow Theory is going to be called public participation, right? So this is when the market shoots up. This is when you typically start seeing your retail investors get involved. So if you think about the first phase, accumulation, as being like your smart traders, your smart money, the people who are in the know about the stuff. The second phase, this is when the public gets involved. So we're doing all this cool stuff, it's happening, and then like the public hears about it, ooh, for real? And then everyone starts rushing for it. And that's when you see these big trending moves. This is an Elliott Wave Theory thing too, but again, I'm gonna try to focus, so this isn't a whole hour-long training lesson. But that big extension, that's gonna be your markup if you're a Wyckoff person. It's gonna be your public participation if you're a Dow Theory. And then after that is gonna be called your exhaustion. Again, that's what I call it from Wyckoff. I'm trying to remember what Dow called it. I think he called it your excess phase. Anyway, this is where the buying starts to slow down, right? So price has moved from blank level, it's shot up a lot of people are making money, and then all of a sudden 2 things are happening, right? When we go back to supply and demand, the price has gotten so high that not as many people are interested, right? There's a good Trading Coach podcast episode called Supply and Demand for Dummies. You need to listen to that if you haven't done so already. It breaks it down in the most simplest Akil ways ever. But once price gets to a high enough level, you're like, I don't want to buy it anymore because it's too high. And you also have people that bought it very, very low saying, think it's high enough. I'm going to cash out and take some profits. And essentially you see a loss of momentum. You start to see the market take a breath, and you start to see those pullbacks that we spoke about. And then eventually the price gets to a low enough level where it either repeats the cycle or some economic stuff has happened and we go into a bearish trend. But these are the three phases of the market. And these are important to understand because as retail traders specifically, we often think, and this is because the internet is spreading all this weird stuff about smart money concepts and this and that and blah, 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 blah. We think that we have to trade like smart money. And the fact of the matter is we don't. We, in my opinion, have a massive benefit over smart money, right? In that accumulation phase where I said smart money is secretly and sneakily accumulating their position, they have to do it that way because if they entered their full position at once, they would move the market against them and lose money. So they have to play this dumb little game of like probing and probing, which is, not fun. As a retail trader, because our accounts are so small that it doesn't really matter, we can buy and sell whenever we want. So we have the freedom to kind of sneak in and sneak out. We are like the fly on the elephant's tail, where if an elephant moves, everyone knows an elephant can't really be sneaky, or it's very hard for an elephant to be sneaky. If we're a fly just hovering around its tail, then we can just kind of go in and go out with that elephant and no one really notices. And that's kind of our opinion. So, or kind of our job in the market. So instead of being like smart money, our job is to be able to identify that elephant, identify when smart money is doing the things that smart money does, and then hop on for that ride. And that ride typically begins in that second wave or the very beginning of that second wave of public participation. And then we let the rest of the traders kind of buy it up. Now, what happens and where a lot of retail traders get into trouble is at the excess phase, this exhaustion phase, right? The exhaustion phase is typically the time everyone hears about it, right? This is the same stuff, right? This is our consolidation or accumulation. This is our markup phase. This is our distribution, depending on if we go another accumulation or distribution, depending on if we go up or down. It's all Dow theory. It's all Wyckoff cycles. And yes, Elliott waves play a role in that, or not. I shouldn't say play a role. Let's say exist, because I don't know how much they play a role, but they exist in the natural ebbs and flows. Now, the separator, like I said, Devin, is do I analyze Elliott waves and do they play any role in my trading? Absolutely none. Absolutely none. So I would never try to count Elliott waves personally. I would never try to predict Elliott waves personally. I just don't give them any value. I'm not bashing any Elliott wave traders out there, right? People say the same thing about pattern formations, classic patterns, simple patterns, advanced patterns. So I have nothing against Elliott waves. They're not like bad or false or unreal. They just don't play any role in my trading. But I do recognize how they exist and how they form in the natural kind of movement of the market. Is anyone else, is this cool for you guys or no? Am I the only one? Right? You guys are now seeing we have a 5-0 pattern and a bat pattern, all within the Elliott wave cycle, all within a bigger Dow theory cycle of how the market moves from accumulation to markup to distribution. Like, this is crazy, right? This is why Beverly asked a lot of questions about like, why does this exist? Why did this is it. This is how it exists. This is how this living, breathing organism of a market moves within kind of macro and micro principles. Like it's like this stuff is crazy. It's crazy. I've spent too much time around charts. Devin says, from what I've read on Elliott waves, very little. It's difficult to determine a start. Yeah. It is, even if you think finding an X to A leg is subjective, that's got nothing on Elliott waves. Because, so think about it as in general, the markets move in fractals, right? There are moves within moves. So like, what is the start? How do you identify the starting point? Obviously, there are techniques to do it. I would look for periods of consolidation, start off of that. But even that, I mean, yeah, if you think finding X to A legs are difficult, try measuring out an Elliott wave. Here's a simple way. If you're looking to trade them, here's a simple way I would trade them. Look for a period of consolidation. Look for the breakout of consolidation. Look for the pullback into consolidation, and then trade that pullback. It's exactly my breakout strategy. And you can say that, hey, you know what? Look, I'm catching a second wave or a second extension, third wave, if you want. Yeah, I would just do it like this. I like to simplify things. Wait for price action to break out, look for pullback, trade the first pullback. That'll get you on the second wave. Third wave, sorry. I hope you enjoyed the video, and I do want to say quickly that if this felt a little rushed, that's because it was taken from a much longer conversation inside our live trading room. It wasn't originally designed to be a standalone lesson, but I wanted to give you something of value. With that being said, if you're looking for something more structured, slower paced, and easier to digest, I highly recommend joining us for our upcoming 2-day online trading workshop. It's going to be about 6 hours of focused training built specifically for beginners and those struggling with the craft. Plus, everything is recorded, so you can either attend live or I guess, revisit everything afterwards at your own pace. That way you can let it sink in. Now, we're about 3/4 way towards capacity as of Sunday, so if you're serious about leveling up, make sure you go ahead and secure your seat before we close registration. I appreciate you watching, and I'll see you in the next video.